Greetings, everybody. This is the ASCM Eco-Sustainability webinar. Today's subject is the Field Guide to Sustainability Reporting Frameworks with Dr. Gwendolyn White. Please be sure to keep your microphone turned off unless you're going to ask a question so we don't get any extraneous noise. So I'm Sandy Friedman. I'm the master instructor, one of the master instructors with ASCM. I'm also on the advisory board of the ASCM Eco-Sustainability Special Interest Group. I'm very privileged today to introduce Dr. Gwen White as our distinguished speaker. Gwendolyn White, PhD, CPA, GRI certified sustainability professional, is a lead trainer and consultant with the ISOS group, a GRI training partner based right here in San Diego. She is the author of Sustainability Reporting, Getting Started, 2nd edition, published by Business Expert Press. In addition to GRI training, Dr. White has also delivered courses that cover integrated reporting, sustainable development goals, the Sustainability Accounting Standards Board, and the Carbon Disclosure Project. She was chair of the City of Bloomington, Indiana Commission on Sustainability from 2015 to 2019. Her work experience includes consulting on sustainability reporting, writing research reports for the World Bank, being on accounting faculty at Indiana and Ball State Universities, and working as a staff auditor for KPMG. Dr. White earned her PhD in Business Administration from Indiana University's Kelley School of Business. She is also the founder of Sustainability Within Reach, LLC. In her spare time, Dr. White and her family enjoy scuba diving in Florida and the Caribbean. All right, please say hello to Dr. Gwendolyn White.
Thank you. I'm so delighted to be here, and I hope that by the time we get done today, things will be clear, and I'm open to questions. You know, probably at the end we can take questions. But my major goal in what I do now in training, professional training, is to make things clear so people can do good reporting. And good reporting, I hope, leads to good action. So let me go ahead and get started with, I've called this the Field Guide to Sustainability Standards and Frameworks. There's a lot happening in this field. It seems like every day I work hard to keep updated myself. So what I think we'll start with, I'll show you the outline that I have set up here. We're going to look at what's called the Big Four. I don't know if anybody really calls it that, but just to kind of get ourselves situated, these probably would, I thought about this, maybe we should call them the old four because they've been around the longest. And but these are fairly well known, and I want to explain those and how they do work together. It seems like they're not, people may think it's all or nothing. I have to choose one versus another, but they can work very well together. And also their prevalence. How commonly are they being used, by large corporations? And then we'll look at other frameworks that are not in these four and what their prevalence is and then what's coming down the road for companies in different parts of the world. And in particular, the EU, the US, and internationally, and how they might affect your companies, your clients. So we'll take a look at those. So we'll look at the Big Four. The first framework, and down at the bottom in each one of these boxes, I've labeled them as, are they a framework? Are they a standard? And so we'll take a look at that. So integrated reporting will be the one we'll talk about. We'll talk about the Sustainability Accounting Standards Board, or SASB, which is the common name that it's given, but it is a standard. The CDP, it used to be, it feels like the artist formerly known as, but a lot of these frameworks, questionnaires, etc., they start out with a full name and have gone to just the initials because they're more than what they initially started out with. The Carbon Disclosure Project is now CDP because they do more than carbon. There are 3 questionnaires. There's a carbon climate change questionnaire, there's a forest, and then water. So lumping all those under one house, it's now CDP, a not-for-profit organization. And then we have GRI, or the Global Reporting Initiative. It is a standard. So we'll look at all 4 of these and we'll look at their focus, we'll look at who their audience is. But these 4 have been around the longest in this world of sustainability reporting. If you think about who was there first, the Global Reporting Initiative was the first on the block officially. They began in 1997. And their first, they were called a guideline initially, and then evolved into being a standard. But their first guideline was in 2000. CDP has been around since 2000, so over 20 years and going strong. SASB originally was created in 2011. The standards that they created came into full force and launched in 2018. Integrated reporting, the idea's been around for a while. I would say officially as a kind of a framework, the concept 2010, 11, and then launched in 2015. So these 4 commonly referred to, and we'll see their usage in a little bit. So I want to talk about the focus. Integrated reporting. The idea is that integrating both financial and non-financial information so that organizations are thinking in an integrated perspective, that it's not distinct sets of reports and that we only focus on, when we look at financial, we only care about financial, but that all of these are brought together to help with risk assessment, value creation, and it is meant for both public and private sectors. And in South Africa, the cities and the government agencies are required to do integrated reporting. So you can see it being applied for both private companies and for not-for-profit. And the Johannesburg Stock Exchange requires that all companies listed would submit an integrated report. And we'll talk about what that really means. What is an integrated report? If we look at SASB, and SASB is very industry specific. It is a set of standards that has non-financial metrics so that investors can assess economic, environmental, and social metrics. Okay. We look at CDP. This is the focus. We'll look at that in a little bit, but providing investors with environmental data. So these are questionnaires that companies respond to. Companies can be asked to respond by investors. And basically CDP is the intermediary. They have members that are investor members, and they also have supply chain members. So if you're a company and you want to know how your suppliers are dealing with climate change, water, or forest, you can join the supply chain membership group through CDP, ask CDP to submit a request to that particular company to respond to a questionnaire. And then it's up to the company to respond. And companies that do not respond, this is really quite a lever of influence. If they don't respond, they get an F score, which is then on CDP's website next to the company's name. So I jokingly, and I'm sure they're not joking about it, but call it the wall of shame. You know, if you have no response at all, don't respond to the email, then that is the score. So as I said, there's 2 groups, investor group signatories that pay money They pay money to have these various benefits that CDP provides for data reports, et cetera, and also the ability to request that a company they're interested in respond to the questionnaires. GRI, Global Reporting Initiative, this is providing the ability for all stakeholders who are interested to look at data about a particular company's impacts, impacts on the environment, on society, and also economic impacts. In addition to governance, we hear a lot about ESG and the G being governance. Governance tells us a lot whether or not a company, it has their top board or top management involved in sustainability kinds of decisions and information. So here's all four, the information I just went through in terms of the focus of each one of these standards or frameworks. More detail about each one of them, if we look in specific at integrated reporting, this is going to tell us how an organization's strategy, governance, performance, prospects lead to value creation in the short, medium, and long term. So this value creation idea, value can go up and down. And so in terms of looking at what this means, this is a framework which has no KPIs, okay? It's all principles based, and it is the reporting, the idea is it's a high level analysis from the top CEO, the board, discussing the organization's short, medium, and long-term value creation prospects and achievements. And there are 6 capitals that are part of this framework, things like the natural capital, intellectual capital, financial capital, manufacturing. So those are some examples of the inputs going into an organization. SASB has 77 industry-specific reporting standards. I teach a course on SASB, and I have yet to read all 77 separate industries, but I'm getting there. I work at looking through those industry-specific, the consumer goods is a sector, and under consumer goods, one of them is apparel, and then one of them is appliance manufacturing. So there is, for each industry that they have listed, a separate standard that provides both quantitative and qualitative metrics for sustainability, both environmental and social KPIs. If we look at CDP, I said this is suppliers in the supply chain, membership or investors can ask for information about risk and opportunities that a particular company has with regard to climate, water, or forest, and also cities. Cities are a part of this as well. And there is a listing of cities that have responded to the questionnaires from CDP. Now, keep in mind that this oftentimes companies start out, they may not have a lot of things they can talk about, but it's a journey, it's a process. And so companies can talk about assessing their risk, assessing their opportunities. It's not always the negative, but also an opportunity to write or to talk about your opportunities that climate change or water mitigation impacts has given you. If we look at GRI, these are standards, and any organization of any size, any location, any type can use these standards to issue sustainability reports. I have worked with companies or organizations. I helped produce a sustainability report using GRI for a city, for an airport, for a not-for-profit community center, okay, and for a university. So just to give you the sampling of not-for-profits or, that can use this standard, it's a really flexible approach to reporting. Who's the audience for these four? If you look at the first three, they're global investors, they're large institutional investors. So these first three have a very focused stakeholder group that they are, aiming at, where GRI has a very broad stakeholder approach. Its investors are part of that, but they're not the major focus. So it's communities, it's NGOs, employees, government. These are all examples of stakeholders that the focus is much broader than integrated reporting or SASB or CDP. And so I've got a red box around GRI because that's a distinguishing component of GRI's reporting. And format, my gosh, there's no designated format for all of these, other than the CDP has the questionnaire, and they are very strict about the way that you answer. You download a Word file, you have spaces where you can input qualitative information, also quantitative, and they also limit how much you can input. They may have like 2,500 characters for a particular answer. They don't allow you to do a lot of linking to other sites or attaching documents. So they're probably the most rigid in terms of format, but these others, you can use whatever style you want, however you want to do it. That's both a plus and a minus. From a perspective of a reporter, you have a lot of flexibility as to how you put it together, where you put it on your website, etc. But from a reader, if you say, well, they're not standardized in terms of format, if I'm an investor type and I'm trying to gather up all this information, it makes it maybe a little harder for me to do across companies. Okay, so how do they all work together? I've shown you the four, and in terms of, I've taken this from the consulting firm BSR's publication, 5 Steps to Good Sustainability Reporting. And what I will tell you is that you will, I believe, get a PDF of this slide deck. And all of these things that are underlined are linked, hyperlinked. So you can go directly to, I've set this up so you can go directly to these documents or to the websites. So starting at the top of the triangle is the integrated reporting. I mentioned earlier that this is an overview. It's a top level discussion. So it is intended to be clear, concise, an integrated approach to how the company is creating value. And it's to introduce you to the company's efforts and what they're doing, how they're doing it. And there will be data to support it, but the framework itself, the integrated reporting framework created by the International Integrated Reporting Council, IIRC, they created it so that you incorporate the 6 capitals that I mentioned earlier. I don't see as many companies talking about the capitals in specific, like this is a natural capital we're talking about, but they weave in environmental things, they weave in financial things, but they don't all necessarily say, and now we're going to talk about human capital. But human capital is mentioned more than maybe financial capital per se, okay? But you have the freedom to use this framework. There are some reporting principles that you must or should adhere to. Underneath integrated reporting, the integrated report is the Global Reporting Initiative, the 10K from the SEC, and a SASB report. So the integrated report uses the information from this second level of the triangle. And, so just showing you that these are sustainability reports and things coming from the 10K or any kind of financial report that you must do. So that's the second level. And then underneath is the bottom level, which involves specific issue, specific things, country specific reports, a variety of things that you can use to supplement, to support what is in the integrated statement. Okay. So they work together, and the integrated report being at the top, a concise statement from the CEO, bringing together all of these things to make an assessment about value creation currently, midterm, long term. And they vary in terms of how they are worded and, how many pictures they have. So there's freedom to be as creative as you want in terms of presentation, but having the principles incorporated and providing reference to these other documents is very important to supporting the conclusions or the prospects of a particular company. All right, I'm going to talk about the Global Reporting Initiative and its prevalence. So there are multiple studies that are done frequently by KPMG, PwC, BSR, lots of consulting firms put together surveys so that, there's a sense of, well, where are we today? There's a lot of changes happening. And so in 2022, KPMG, they do multiple years here, did a survey, and they found that 78% of the G250, the largest 250 companies in the world, were using GRI. And that is up from 2020, which was 73%. So GRI is still alive and well and strong. And, we're looking at also the breakdown of what percentage in the Americas, Asia Pacific, Europe, and Middle East and Africa. So that is one example of research that shows how prevalent GRI is. And once again, if you are interested to go to the source document, it is hyperlinked at the bottom. There's another organization called Governance and Accountability Institute. They are a consulting firm. They do a lot of research, both for companies that want research done. They do a lot of publishing of their data gathering that they're involved in collecting information. In this particular study, it's a 2022 report. They do this every year, so there's always a new one. And they looked at the Russell 1000 index companies. And so this represents 93% of the total market cap of all listed stocks in the US equity market. So this is based on the reporting of these companies. And we'll take a look at what they found in terms of prevalence of these standards and frameworks. So the SASB standards, if we look at dramatic increase from 2019 to 2021. So 2021, 67% of the Russell 1000 were doing a SASB report. If we look at GRI, again, there's been an increase. And CDP, 44% of those companies responded to the CDP climate change questionnaire. Okay. And then a little more on CDP, which is an interesting and amazing thing that happened in November 2022. The Biden administration announced that the major federal suppliers will be required to disclose to CDP. It's a dramatic thing, because they're going to have to be, and there's a dollar threshold that defines major federal supplier, but if you think about that, it's not going to stop there. The suppliers requested to respond are going to have to ask their suppliers and so forth and so on. So to gather data about upstream, et cetera, they're going to be start asking up the chain. So I thought that was quite an interesting development, and there will be a lot more work for CDP consultants. So, but I think it's all in a very positive approach. But again, interesting development. If we look in detail at CDP in terms of the climate change questionnaire and the reporting guidance, CDP has on their website a lot of information and a lot of documents for guidance on how to report to the questionnaire. They have a lot of information about their scoring methodology. What are they looking for? They give you tips on, what makes a good response and what does not. Very specific responses will get you more points because these responses are graded. CDP has their criteria that they use to grade the responses. And again, if you don't follow the instructions or you leave anything blank, then you really hurt your score. So I think the score represents two components. One, your actions, your assessment of your own risk, the content is quite important, but also how you've responded. How have you articulated your risk, your opportunities? All that really matters. And if you're too vague, if you're not providing the kind of detail that's necessary to make an assessment, then that'll hurt a score. Okay. And CDP is pretty upfront about that if people are willing to go in and look at all the guidance documentation. It takes some time to read through that, but so important. And in terms of what methodology do companies use to report their greenhouse gases? The vast majority of big companies use the greenhouse gas protocol, and CDP encourages companies to do so if they're not using some sort of national standard that's specified. So the greenhouse gas protocol, this is available free for download at their website, and they have three documents and standards. One is for scope 1, which is your direct emissions. If you own the cars, the trucks, and the gas you burn is a direct emission. If you are buying electricity from a power plant, then that is a scope 2. You're using that electricity, but you don't own the power plant. So that typically is scope 2. And then the scope 3, there's a document for guidance on, and that's everything else. So scope 1 is your direct, what you directly emit. Scope 2, power, heating from your purchasing. And scope 3 is everything else. So it's your upstream, downstream, commuters, your workers, their greenhouse gases getting to work, business travel. Those are some examples of that scope 3. But the greenhouse gas protocol has a standard for each one of the scopes, free for download, and it's quite detailed. And again, not an easy task to do a greenhouse gas inventory, but in order to make progress, one has to, first of all, measure and then look to see how well you're doing over time. We're going to look at some other sustainability reporting frameworks, if you will. I don't know if you're familiar with GRESB, and GRESB used to be known as the Global Real Estate Sustainability Benchmark. It is no longer Global, Global Real Estate Standard Benchmark, but it is GRESB. So that's their official name because they do more than real estate benchmarking. They do infrastructure, assets and funds, offering scorecards, portfolio analysis, and other benchmarking. So the reason that I have brought this in here as something for the supply chain is because it is relevant for the supply chain. I'm going to show you in just a minute, but if you look in terms of this segment of the market or just the industries, in terms of the entries that they are entities that participate, almost 2,000. We're looking at over $6 trillion of gross asset value, over 74 countries. And in terms of growth, in terms of the respondents, has 30% in the US, Asia Pacific, and Europe growing. Now, why would it matter to a supply chain or anyone in the supply chain? It matters because I want to show you some of the questions and let me tell you that the GRESB assessment for real estate, it's a questionnaire in essence, and companies oftentimes are requested, just like CDP, is companies will request that another company respond to GRESB. And in the real estate industry, if you're an investor and you want to perhaps invest in a REIT, this real estate investment trust, and you say, well, I want them to respond to the GRESB assessment. So when a company has been requested to do so, they probably will do it because an investor has asked. And so in particular to the supply chain, in the supplier section of the questionnaire or assessment, and these assessment questions are available on GRESB, the website, for anyone to download, to take a look. So in the supply chain engagement program, the question they're asking here, does the entity include ESG specific requirements in its procurement processes? If the answer is yes, then you have this drop down that says, what are you doing here? Are you developing or applying ESG policies, so forth and so on. So very tailored to the supply chain. And the topic areas in these questions: business ethics, child labor, environmental, health and safety, so forth, human rights. So these are ESG topics. Then the SDGs, which is a set of goals, the Sustainable Development Goals that have a time frame from 2015 to 2030. And these are country goals. These are the member nations of the United Nations voted and agreed that these, to adopt these goals. This is not legally binding on countries, but 193 nations agreed that it was a good thing to do. And why this is in here is that businesses are encouraged to support the goals. There's 17 of these. They deal with social, economic, and environmental issues that are challenges facing the world. And one of the goals is, the first one is no poverty. Eliminate poverty by 2030. Okay, that's a tall order. Countries are reporting every year how well they're doing on their goals regarding that. So, but companies, if they can identify a goal or goals that they can help support, like decent work is an example, working conditions, that would be another one they could support and report on how they are supporting their employees with training, etc. What is the prevalence of reporting in the Russell 1000? From 2019 to 2021, you see a dramatic increase in more companies reporting their support very specifically. Okay. I've seen a lot of companies paste on a SDG icon, the climate action one. That's fine, but that's not what we're looking for. We're looking for real specific details about how your company is, one, reducing your greenhouse gas emissions and tying that to a specific SDG. Then we have TCFD, the Task Force on Climate-Related Financial Disclosure. This is a set of recommendations, recommended disclosures, and the prevalence of that is dramatically increasing, from 4% in 2019 to 34% in 2021. That's a dramatic uptake, and it's growing all the time. And I want to talk more about TCFD because you'll see in a moment that it is the foundation for a lot of things. There are 4 pillars. First 2 here, governance, and that's disclosing how your board and management are dealing with climate-related risk. Very specifically, what are they doing? Okay. Strategy, asking the organization to list what are their risks and opportunities with regard to climate-related financial risk. How does that affect their strategy, their business plans, their financial plans? And then looking at scenarios. What resilience do they have if the world's climate increases, by 3 degrees or 1.5 or 2? So looking at scenarios. And then the last 2, risk management and metrics and targets. Risk management, it's processes. What are your processes to identify, manage, and integrate climate-related risk into your overall risk approach? Metrics and targets, what are your metrics for assessing climate-related risk? And the second thing in the metrics and target is tell us your greenhouse gases. What are they? Give us numbers. And then the third one is, what are your targets to measure, future aspiration, and how have you done? How have you done meeting those targets? So those are the 4 pillars. And I go in detail here because they're so important, because they are the basis for other disclosures by international financial reporting standards, the SEC, and the Corporate Sustainability Reporting Directive out of the EU. So those 4 pillars appear again and again and again in the newest proposed reporting standards and disclosures. So what is coming? Okay, what's coming down the road and sooner than we know? There's something from the International Financial Reporting Standards Foundation, IFRS Foundation, something from the US SEC, and something from the EU. So those are the 3 groups that are creating at the moment, in final stages of their reporting requirements or standards. So we'll look at each one. And if we look at the current IFRS Foundation, that is houses the International Sustainability Standards Board. It's a newly created board within the last couple of years, and they are creating climate-related disclosure standards. And they're very close to having the final version done. Supposed to be the first quarter of this year, but I think we're talking the second quarter for the final. The SEC has it's a climate disclosure requirement, and Preston and I were talking earlier that the newest information is that the fall will be the final release date, because it's had so much attention and comments and pushback from a lot of fossil fuel companies, a variety. So they've delayed the final release of this. The EU, the Corporate Sustainability Reporting Directive, that was adopted into law by the EU in November. It's a required reporting for companies that are in the EU and also companies that are non-EU companies meeting a certain threshold. So there are reporting standards, the European Union's sustainability reporting standards. Those are to be adopted, finalized very soon, okay? So those are the 3 proposed reporting regulations and standards that are major. So let's dive into the IFRS Foundation. And just so, if any of you are familiar with the International Financial Reporting Standards, this is the accounting standards that are used around the world for financial statements. And there are 145 jurisdictions that require these accounting standards. So stock exchanges, different countries, a total of 145 are using these accounting standards for required reporting. The US goes their own way. They use generally accepted accounting principles. That is what is required in the SEC 10K. How different it is from the International Financial Reporting Standards, there are differences. Enough to drive companies a little crazy, but similar in many ways, okay? So IFRS Foundation, they've got 2 standard settings board, the International Accounting Standards Board, they set the accounting standards. The International Sustainability Standards Board are setting the sustainability disclosure standards. Now, the hope is the IFRS Foundation and their standards board hopes that all 145 jurisdictions who have required the accounting standards will require the sustainability standards, okay? So it's up to the jurisdictions to make that requirement for this to be a requirement anywhere. Anyway, just to tell you that mergers have happened. I talked earlier about the integrated reporting and SASB. And so just to show you on this slide, integrated reporting and SASB are now under the auspices of the International Financial Standards Board Foundation under the ISSB. So they're now all in one happy family, but just so you know that those are all together at this point. To show you kind of stepping back, well, what is the International Sustainability Standards Board doing? They're creating standards. They're providing standards with the idea that the accounting standards will be supplemented, complemented by the sustainability disclosure standards, so that this will help investors make decisions based on investment useful data. Just, this is just to show you what is in the current proposed standard from the ISSB. You can, at your own leisure, go and see where it is right now. Almost done, not quite. And same thing with their second standard. There's 2 out there. And what I'm highlighting here is that they are using the TCFD, those pillars, those 4 elements, and that's a major part of these standards, along with the SASB standards. Let's go into the SEC. What's this about? Public companies, the requirement to report on climate-related financial data, greenhouse gas emissions, put this in the public disclosure filings and disclose emissions that scope 1, scope 2, and scope 3. So up and down the supply chain, value chain as well. There will be a requirement for third-party attestation on just scopes 1 and 2. We don't know. We hope 2023. The EU's reporting directive, this is going to require, it's requiring all large, all listed, and some non-EU companies to use these European sustainability reporting standards. Includes double materiality, a wider range of stakeholders than the IFRS standards or the SEC. Now, let's look at materiality. What are we talking about? Materiality is putting things into a report, only the things that are significant. You don't want excess stuff if it's not relevant and if it's not significant to your company. So we're going to look at material impacts. And so here we have the GRI. Their approach is, let's look at your impacts going out. What are your economic impacts? What are your environmental impacts? What are your social impacts? So it's from the company going out. And when I show you this next part, it will say, it doesn't matter if it's financially material. GRI doesn't care, okay, if it's a financially material item or not. What's important is that it is a material impact. So just because it's not financially material doesn't mean it's not material. So how I treat my workers, that's an impact I have going out. Whether or not I'm paying taxes, that's a economic impact I have on a community or a state. How much greenhouse gas I emit, that's an impact my organization has going out. And I throw in there financial splashback. It could become material financially, but that's not the major focus of GRI. Okay, so double materiality looks at the going out, we've talked about just now, but the coming in, the going in. TCFD, we've got climate-related physical and transitional risk. Those are things that can affect my income statement, my balance sheet, my cost of capital. Those are things coming into my company. If we look at SASB, SASB has five dimensions of sustainability, and I'm just picking on social capital. And in the auto industry, product safety is an example of a social capital issue. I care about product safety because it'll make a big difference. If my cars are not safe, people are not going to buy them. So there are metrics to talk about product safety in the standards. It's the impact coming into my company. If my product safety is not good, then it's going to affect my revenues. It's going to affect my expenses because I've got to fix those defects. Okay, so this is impacts going in. This is financial materiality put together with impact materiality, things that I'm doing that are going out. That is double materiality. One of the impacts, financial impacts coming into me, and then the impacts that I create going out. Together, it's called double materiality. Just to talk about the EU, who's covered? EU companies, and two of these things have to be satisfied to be required for reporting to the EU if you're an EU company. So there is number of employees, there's revenue or assets, and the publicly listed equities have to have 10 employees or more and a certain amount of millions of euro revenue. Non-EU companies, you're covered. You have to report to the EU if you have more than 150 million euros annually within the EU, and also one branch or subsidiary in EU locations. So the requirement is these reports will be assured by a third party. So what are those reporting standards required? These are the European Sustainability Reporting Standards. You'll see a similarity with GRI. There's an environmental component, there's a social component, there's a governance component. We're not going to go into the details, but you get an overview that there's consistency in terms of sustainability reporting, the topics that are covered: climate change, pollution, water and marine resources for the environmental. Those shouldn't be surprises to people. Social, your own workforce, workers in the value chain, workers in the supply chain. So these are relevant to supply chain issues. Looking at, stepping back, okay, the 3 proposals issued in 2022. So I talked about the SEC and slated to become US law. And I make a specific emphasis here that when finalized, this will become law. Whether or not it'll be challenged, it'll probably be challenged, but the idea is that it will be law. The second one, the EU, the European Sustainability Reporting Standards, will and is European law, EU law. So if you fit the required reporting disclosures, if you're one of those non-EU companies, you have a certain threshold of revenue and employees, then you are going to have to report using those standards. And then the third one, the ISSB, depends on the jurisdiction, depends on the stock exchange in the country around the world. So of those 145 jurisdictions, it's not clear if they will require, which ones will require, and they can also do a little of their own tweaking. Each stock exchange can change some things in these standards. But bear in mind, all 3 of these base their disclosures on the TCFD 4 pillars. Okay, they vary in certain parts of it, but the fundamental basis is based on TCFD. So I've come to the end of the session, and I want to open this up for any kinds of questions that you might have. I threw a lot of information at you fairly quickly, tried to make it as high level as I could, and yet provide you with enough detail. I'm going to stop my share so that I can open it up and see if there are any questions.
Thank you very much, Gwen. An outstanding presentation as usual.
Thank you.
Please bear in mind, there is no such thing as a silly question.
No.
Right? All questions are relevant and they help clarify. And I would also just say, what a good way of framing it so people feel okay about asking questions is, this is a test of the instructor after a fashion. So if you don't ask questions, either you got it completely and you're ready to go out and outside to the world and you're an expert, or you have a question because you want to become more knowledgeable.
Well, I have a comment. I'm just going to say I'm very pleased to see that a lot of this stuff is becoming law. I was not aware of it. Biden administration passed that law last year, so that's very encouraging.
I have a question. I'm from the Seattle chapter. I noticed that the prevalence across the board has jumped up in the case of virtually all reporting systems between 2019 to 2021. Is it just a coincidence or is it the impact of the COVID?
I think there's so much more demand now for reporting. A lot of investors are asking for more information from companies. So that I think is a lot of the drive that's happening. I constantly hear from our clients that, oh no, we're being asked, and so, and the idea being that it's part of the risk assessment that's going on.
Thank you.
Can I make a comment just in general about, this is my observation. I don't know if it's 100% accurate, but it's kind of one of these things that I pieced together in my mind. The CDP, Carbon Disclosure Project, its membership includes institutional investors. Now that's kind of dry when you say institutional investors, but it becomes lively when you talk about how much money they actually control for investment. The membership of CDP that are institutional investors control 115, or I think it's 112 or 15 trillion dollars. Another component of membership of the CDP happens to be the Global 500. The Global 500, most of them do all the reporting, but guess who they're really, I suspect, there for? They're there because the money that every corporation eventually needs ideally will come from institutional investors, right? So they're clustering around becoming compliant. Then I start to look at things and how this kind of weaves its way down, that stock exchanges want to deal with risk because institutional investors in CDP care about risk, as well as the Global 500. So they want to make sure that people trade on their exchange, right? So they're going to become compliant. So it's kind of working its way top down. And recently, the Fed has become, in the United States, the Fed has become very interested, and they have taken the five largest banks, and they're going through the initial prototyping of how they would assess risk on the climate, et cetera, before they make loans, because they're tired of all these bad decisions being made, and now they don't want this big wave of liabilities that and banks being put out of business because of not having these disclosures, because GHG emissions and water use is a measure of risk. So it's getting down to the point, maybe I'm wrong, but that's my strange brain connecting the dots all the way through. It's getting to the point where a corporation may not be able to go get loans at a decent interest rate, and every corporation needs to borrow money if they want to expand or do this or make payroll or whatever. And that's going to get tighter and tighter and tighter. And it's because of climate change and how they address it. Either they have free access to money, relatively free access because they're performing, or if they're not performing or they're not making progress, then life's going to get pretty testy and difficult and expensive. So I don't know if my take on this is correct, but I'm not a financial person, but the dots just seem to connect pretty easily for me on this top-down progression. Investors, a lot of money. I think that's 5 times the gross domestic output of the United States, 5 times that size or so, something in that range, influencing the Global 500, who really would like people to invest in them, including exchanges who really want they want stocks, on their exchange so they can make money because they're a business, down to the Fed, who really cares about distortions in the economy, and down to the banks who really don't want to take on a client who goes belly up because they are, their assets are useless. There's always been big debates about stranded assets for oil companies, for example, and how much they say they are, and whether or not they really will be worth anything 10 years from now or 20 years from now. So I don't know. Gwen, any comments on that? And is there something wrong with my thought process?
No, I think your thought process is just fine. And that it is trickling down to the business decision level.
Right.
If you're looking at risk, that is just more risk data points to look at. It's just, if you ignore the ESG part, you're lopping off a big set of data that feeds into the whole. It's not saying we're throwing out the financial analysis. No, we'll never do that. But that it adds to the information that we have to make those assessments. And, just thinking about companies that trying to assess, if I'm looking at Coca-Cola or Pepsi, I don't mean to name names, but just, or companies that depend on water as a major product. And so where are they located in the world? Are they in water stressed areas? If I'm evaluating a company from a risk perspective, Could be a hospitality company where they have chains around the world, hotel chains. If they're located in water risk stressed areas, that puts them at risk because they use a lot of water. But will they have the social license to operate using tons of
Right.
water? So again, it's part of that assessing how are they managing, dealing with risk coming down the pike for them, whether it be water or whether it be their physical assets are at risk. So there are a lot of companies now that are doing data analysis, like you showed me the climate risk earlier, the website that shows what are the climate risks in different parts of the world. That's really crucial to understanding whether or not I want to put money in a company has assets in that part of the world. So, yeah. Any other questions?
Any comments?
Yeah, I have a comment. Just, I hate to dominate this, but I just want to make sure that my thinking is straight. All these acronyms and all these organizations, when I first saw them popping up, I said, what is going on? If you're into manufacturing operations management, the old Apex stuff, and which has evolved to include supply chains, et cetera, with the ASCM stuff. We're an acronym. We like acronyms. We're comfortable with them, but I found this to be a little bit overwhelming. And then what I realized is that new standards were being evolved that had a different acronym that filled a hole. And what was going on was really the absorption of the new into the old, meaning they were plugging in the new. It wasn't that the new was displacing fully the old. And we've had discussions within our group, and we're saying like SASB will still be around, but now it's embedded into ISSB. The CDP is still there because they have agreements with everybody because they're a trusted partner, and and everybody else, in reality, everybody else was kind of plugging into them after a fashion for the most part. So even though there's a lot going on right now, and it looks fragmented, it really isn't. It's just that you have to use the old an acronym for what someone was using, which really won't go away, but it's being absorbed into something more comprehensive. I don't know if I expressed it. And plus, having lived in Scandinavia and Europe and the UK and lived my life basically born in the US, there always will be differences between the EU view of things, but they'll be very similar to ours, but there will be a difference in the US because they're not as homogenized as we are in the US, because they're still in this process of taking different cultures, et cetera, and amalgamating them with different value perceptions. So even though they're different, but they're only slightly different. But there's a reason for that, and their systems of measurement are younger than ours. Ours are more embedded over time because we've had a more or less one set of standards for all our states. So but what also I think is happening is at the business level, if you're a major corporation, you always have to satisfy the highest standard, whether that's coming out of the EU or it's going to come out of the US. And eventually, once you get the data for either, it's usable for the others. So correct me if I said something wrong there, because I'm just trying to test my absorption of the information that we've been getting, that I've benefit from because we're doing this initiative, right, to learn.
There is a lot of overlap. So it's not like everything is distinct and separate. And so, you're right. It's a matter of coming together and making them work. I think Monica has her hand up.
Yeah. Monica, go ahead. You're on mute. Monica, we can't hear you. You're on mute.
Yep, I got it. Thanks. So my question is, great presentation of a lot of different standards and how the standards and is all coming together. but relating now back to ASCM, have you taken a look or seen if the enterprise sustainability, that enterprise standard that ASCM is working with, if that meets those expectations as well for companies? The first part of the question. And then the second part is, have you taken a look at the inclusion of all of the sustainability portion back into the score model?
And I'm going to defer to Preston and Sandy.
Well, first of all, I had Sandy and I had the benefit of attending the training course on it. Those who will go out and conduct a course for the association about 4 weeks ago. And there is a tie-in that they've made a very specific mapping to SCORE. They've made a very specific mapping to GRI, and they made a very specific mapping to SDGs. This is the initial version of the course, and it will grow over time. You'll probably see the mention of the Carbon Disclosure Project more prominently in the future, the Water Footprint Network and things like that. But they've done the mapping, and they're very careful to do the mapping, and they've done a good job. It's a good course. It's not, no, let's put it this way, it's going to run 15 to 20 hours. Okay, so this is not a certification level course. This is an introduction, so people have a framework, so future studies, they can start plugging in more information at a deeper level. And so it's, you know, maybe Sandy can make a comment because he's going to be our instructor on the course. So
I'm sorry, I wasn't clear. I'm very familiar with the enterprise standard, and I actually was one of the authors of the SCORE DS model. So I knew those answers, and I was the initial instructor for SCORE DS. So, but I wanted to see from the expert standpoint how any of this is actually making it into the field, or are we just still gathering information from the experts and trying to put that into our ASCM? And so, you know, I guess I got my answer because it was deferred back to ASCM. I wanted to see if it had made it out into any of the standards or any of the things that are being done in ASCM, and the connection to the sustainability and the GRI, if that had made its way back into academia or to other non-ASCM entities.
And I will tell you that with GRI, what GRI wants you as a company, organization, to respond, to disclose and say how you're doing it. So if this is part of what you do in the supply chain, they want a description of what, you know, what the risks are in the supply chain, et cetera. So whatever you're using, whatever methodology to manage those risks, that's part of what you would be using. But there's no specification of any particular methodology. That's the beauty of the GRI, is that they say, you tell us what you're doing.
I'd like to thank Gwen again, and have a good day.
Thank you, Preston. Thank you, Gwen, as well. Wonderful presentation. And thank you, everybody, for attending.